Welcome to the Monkey Business Show, the pulse of finance like you've never seen it. Today we're diving into Carvana's shocking allegations. A financial drama so wild, it feels like it was scripted. Imagine $800 million in auto loans disappearing into thin air, insider stock sales worth billions, and accounting acrobatics that redefine creative. Is Carvana on the brink of disaster? We'll give you the inside scoop. But there's more. Markets are spinning, consumer confidence is stumbling like it's had one too many, and the Fed is juggling rate hikes and recession risks like a circus act. Globally, the ripple effects are raising eyebrows from Wall Street to Warsaw. And to help us untangle it all, we've got someone who knows a thing or two about navigating questionable deals. A sharp, no-nonsense analyst with a colorful past and a wit to match. His insights will hit harder than a market crash and keep you laughing along the way. Stick around. This isn't just a finance show. It's a front row seat to the madness you didn't know you needed.
Buckle up, folks. We're about to plunge headfirst into the chaos of Carvana, the online used car retailer whose credibility is as dodgy as a three-legged racehorse. Hindenburg Research just detonated a bombshell report, and it's echoing across the financial landscape. They're accusing Carvana of a financial misconduct spree so audacious it would make legendary swindlers blush. According to Hindenburg, Carvana allegedly offloaded a jaw-dropping $800 million in auto loans to a mysterious, undisclosed related party. Yes, you heard that right. Nearly $1 billion shuffled away like a magician's trick. They're calling it a father-son accounting caper, but instead of a heartwarming family tale, it's a financial crime thriller that makes The Wolf of Wall Street seem like a children's bedtime story. Oh, but there's more. Carvana's accused of cooking the books to inflate their reported income. If your accountant told you that you had a 50% profit margin while you're actually bleeding cash, you'd question their sanity or their grasp on reality. Or their principles. If this is true, this isn't creative accounting. It's malpractice so egregious it makes Enron look like a minor slip-up. As for their underwriting practices, Hindenburg describes them as lax as a security guard catching 40 winks on the job. They're apparently handing out loans to anyone with a pulse, seemingly oblivious to the fact that lending to folks who can't pay back is a one-way ticket to a stern chat with federal regulators. And the insider stock sales. CEO Ernie Garcia III and his father, Ernest Garcia II, have been dumping Carvana stock like it's a burning building. From August 2020 to August 2021, the elder Garcia sold a staggering $3.6 billion in stock, according to SEC filings. In 2024, he offloaded another $1.4 billion, bringing the grand total to an eye-watering $5 billion. It's as if they're hosting the world's most profitable fire sale. Everything must go before the flames devour the rest. Carvana's response? They've brushed off the report as intentionally misleading and inaccurate, emphasizing their commitment to their 2025 business plan. That's like the captain of a sinking ship assuring passengers that everything is proceeding as planned. Following Hindenburg's explosive report titled Carvana, a father-son accounting grift for the ages, the market reacted with all the elegance of an elephant on ice skates. Carvana's stock nosedived nearly 5% before clawing its way back to close at a 2% loss, settling at 199.56 on January 2nd, 2025, as per the New York Stock Exchange. Investors scattered like ants at a picnic, spooked by allegations of secretive related party transactions and financial magic that would make Houdini proud. Analysts are split like a family dinner after someone brings up politics. On one side, JP Morgan advises investors not to overreact, maintaining their overweight rating and suggesting the price drop might be a buying opportunity, as mentioned by MarketWatch. On the flip side, some experts are ringing alarm bells, drawing comparisons to notorious collapses like Nikola Corporation, which plummeted 90% after facing similar accusations. The stock market's reaction was sheer pandemonium. traders scrambled to adjust their portfolios, uncertain whether to hang on or abandon ship.
Catch me outside, how about that?
For those tempted to buy the dip, remember that sometimes buying the dip just means you're sinking deeper into the abyss. Social media was ablaze with commentary. On X, formerly Twitter, discussions highlighted that Carvana's stock took a sharp dive of about 3.1% following the report. While some see a rebound potential, others recall the fate of companies that ignored warning signs until it was too late. The mixed reactions underscore the uncertainty swirling around Carvana. Is this a mere hiccup or the start of a nosedive? Only time will reveal the truth, but investors would be wise to tread carefully. Switching gears, let's chat about consumer confidence, currently staggering around like a tightrope walker who's misplaced their balance pole. Recent reports indicate that the Consumer Confidence Index has taken a nosedive, plummeting from 98.1 to 85.7 in just a month, according to the Conference Board. It's a drop reminiscent of the 2008 financial crisis. With inflation gnawing at families' wallets and the job market resembling a game of musical chairs with half the seats missing, it's no wonder consumers are clutching their cash like it's the last lifeboat on a sinking ship. Prices have been rising so fast that essentials like eggs are now extremely pricey. Inflation is a problem that has been affecting everyone, but especially the middle class, the backbone of the economy.
So I was raised as a middle class.
The Federal Reserve's reserve balances have declined by over $326 billion from $300.218 trillion down to $2.892 trillion, the lowest since November 2020, according to the Fed's own reports. Officials attribute this to year-end financial maneuvering banks adjusting their balance sheets for regulatory compliance, but it doesn't exactly inspire consumers to open their wallets. Additionally, the Treasury plans to borrow an eye-watering $823 billion in the coming quarter, aiming for an end-of-March cash balance of $850 billion. With the debt ceiling reinstated on January 1st, we're once again treated to the spectacle of Congress debating whether to raise the nation's credit limit while the rest of us hold our breath. All this fiscal juggling isn't boosting consumer morale. When people see economic uncertainty, they tend to tighten their purse strings, leading to decreased spending, a self-fulfilling prophecy that can slow economic growth. Perhaps it's wise to keep a close eye on our finances and regard that rainy day fund as more essential than ever. Turning our focus to the Federal Reserve, we find them performing a precarious balancing act, with the labor market showing signs of weakness and inflation still above target. The Fed faces a tough choice: cut rates to stimulate the economy or keep rates high to tame inflation. It's akin to juggling knives while riding a unicycle. One misstep could spell disaster. Federal Reserve Bank of Richmond President Thomas Barkin recently expressed caution, stating there would be no rate cuts until inflation falls below 2%, as reported by Brink.
Fed walks the line between boom and despair. Inflation's ghost lingers, it's a game of who dares. Raise it too high, the growth starts to fall. Drop it too low, and we risk losing it all.
Meanwhile, key economic indicators are flashing warning signs. The Manufacturing Purchasing Managers Index, PMI, has dipped below 50, signaling contraction. Consumer delinquencies are on the rise, and the housing market is cooling due to mortgage rates hovering around 7%. Yet, despite these signals, investors seem unfazed. The Nasdaq Composite Index rose 1.7%, even as the Fed sounded alarms, according to CNBC market data. It's as if the market is whistling past the graveyard, ignoring the cautionary flags waving all around. I recently shared these concerns on our social media. Don't forget to follow us at x.com/AIFinanceMonkey. In my latest post, I questioned whether the market's optimism is overlooking these red flags. The response? A collective shrug. It seems investors appear to be betting that the Fed will blink first. The Fed's challenge is to manage inflation without tipping the economy into recession. As they navigate this difficult path, the stakes couldn't be higher for the economy and for investors alike.
Housing dreams fading under 7% skies.
Now, let's zoom out and look at the bigger picture. The US economy doesn't exist in a vacuum. It's intertwined with global markets in a complex web. The fallout from Carvana saga and the wobbling US consumer confidence might just send ripples across the globe. If American consumers tighten their belts, it could spell trouble for countries that rely on US demand for their exports. Recall the 1997 Asian financial crisis, where shifts in investor sentiment led to rapid capital flight and economic turmoil in countries like Thailand and Indonesia. Meanwhile, China is grappling with its own economic challenges. Manufacturing PMIs are slipping, and their property market is under immense strain. The interconnectedness of global supply chains means that disruptions in major economies can have far-reaching effects. According to the World Bank, a slowdown in major economies could shave off significant growth percentages from emerging markets. Europe's not faring much better. Germany, the industrial powerhouse, is facing energy shortages and production slowdowns due to geopolitical tensions affecting gas supplies, as reported by the Financial Times. When key cogs in the global economic machine start to falter, it's a signal that investors worldwide need to stay vigilant. In essence, when the United States sneezes, the rest of the world catches a cold. The global economy is watching closely, and the stakes are high for everyone involved. Now let's delve into the delicate dance between interest rates and inflation, a performance where one wrong step can lead to a tumble off the stage. The Federal Reserve is caught in a classic predicament. If they cut rates too quickly, inflation could surge back with a vengeance. Keep them too high for too long, and the economy might slip into a recession deeper than the Mariana Trench. Economic indicators are sending mixed signals. The Consumer Price Index, CPI, shows inflation easing slightly, but still above the desired target. Meanwhile, wage growth isn't keeping pace, meaning real incomes are effectively shrinking, a squeeze that consumers feel every time they visit the grocery store. The challenge is further compounded by increasing consumer delinquencies and a cooling housing market. Mortgage rates are at multi-year highs, pricing out potential home buyers and slowing down the real estate sector, a key engine of economic growth. The Fed's cautious stance, as highlighted by President Barkin, reflects the tightrope they're walking. Historical missteps like those in the 1970s stagflation era serve as cautionary tales. Back then, attempts to curb inflation led to high unemployment and economic stagnation. A scenario no one wants to revisit. The bottom line, the interplay between interest rates and inflation is a complex dance, and the Fed must choreograph it carefully to maintain economic stability. Now, let's navigate the murky waters of short-term liquidity dynamics. The Federal Reserve's reserve balances plummeted by over $326 billion, dropping from $3.2 trillion to $2.9 trillion, the lowest since November 2020. According to the Fed, this dramatic decline is primarily due to year-end financial maneuvering, with reverse repos spiking by about $213 billion as banks adjusted their balance sheets. Simultaneously, the U.S. Treasury plans to borrow a staggering $823 billion in the coming quarter, aiming for an end-of-March cash balance of $850 billion. With the debt ceiling back in play as of January 1st, they're relying on extraordinary measures to keep the government funded, as outlined in their latest report. In the short term, this might inject liquidity into the markets, giving equities a temporary boost. It's like a sugar rush before the inevitable crash. Once the debt ceiling is raised, and we all know this political theater can drag on, the Treasury will need to refill its coffers, issuing new debt and potentially sucking liquidity out of the financial system. This could lead to funding stress and volatility in markets. Remember the 2019 repo market turmoil when short-term rates spiked due to a liquidity crunch? History has a way of repeating itself if we're not careful. Investors should be aware that the current calm might just be the eye of the storm. Keeping an eye on liquidity indicators could provide early warnings of turbulence ahead. As we navigate the early days of 2025, the road ahead appears fraught with challenges. The labor market is showing signs of fatigue, consumer confidence is waning, and geopolitical tensions simmer beneath the surface. The Federal Reserve is attempting to steer the economy toward stability without stifling growth, a task easier said than done. Investors, it's time to stay sharp. Diversification and risk management aren't just buzzwords, they're essential strategies in times like these. Pay attention to the economic indicators, keep an eye on liquidity flows, and don't get swept up in market exuberance that ignores underlying fundamentals. History has shown us that markets can remain irrational longer than you can remain solvent, as economist John Maynard Keynes famously said. But being prepared and informed can help you navigate the uncertainties. Remember, we're all in this together, traversing the unpredictable landscape of the global economy. With a bit of caution and a solid strategy, we might just weather the storms that lie ahead. And now, as we catch our breath after this whirlwind tour of economic chaos, it's time to pass the torch to our esteemed colleague, the British monkey himself. He'll dive deeper into these issues, peeling back the layers to reveal what this all means for our economy, our investments, and perhaps even our sanity. So stick around as he brings his sharp wit and keen insight to dissect the numbers and offer his take on navigating these turbulent times. Trust me, you won't want to miss what he has in store. As we wrap up this roller coaster ride through the financial funhouse, let's take a moment to reflect. The markets are behaving like a soap opera scripted by a hyperactive playwright, complete with unexpected twists and dramatic cliffhangers. Carvana Saga serves as a stark reminder that due diligence is essential. Allegations of financial misconduct, insider trading, and lax controls should set off alarm bells for any savvy investor. It's not about panic, it's about prudence. Meanwhile, the broader economic landscape is filled with both peril and opportunity. Inflation, interest rates, consumer confidence, all pieces of a complex puzzle that requires careful analysis and a level-headed approach. Staying informed isn't just advisable, it's crucial. Follow trusted sources, keep abreast of market developments, and don't hesitate to adjust your strategies as new information emerges. And on that note, don't forget to follow us on x.com at AIFinanceMonkey, for those counting. You'll find insights, updates, and perhaps a bit of humor to lighten the mood in these heavy times. So, as we brace ourselves for whatever curveballs 2025 decides to throw our way, remember this: in the grand casino of economics, the house doesn't always win, but it's wise to play your cards carefully. Now let's see what insights our British monkey has up his sleeve. If anyone can make sense of this financial circus, it's him. Over to you, mate.